Hello and welcome back to FIM 340 Real Estate. Today we'll be doing the remainder of Chapter 18, so this is Lecture 6, Part 2. Following off when we left off with Chapter 18 before, we had done the valuation methods with the market valuation method, and now we're going to do cost and income approach. So for the cost approach, you are looking to see if we have a property that has a uniqueness to it, and therefore it cannot be estimated via market approach because there's no market for that property, and it cannot be estimated via the income approach because the property doesn't produce income. But it's often the case that we still need to apply a value to the property in order to determine its appreciable cost, so that we can get insurance on the property or determine some other reason that we might need it for balance sheets or other sort of financial statements it might be useful for. So again, these items are going to be things like fire stations, school buildings, courthouses, or bridges, for example. They don't produce income, they're not marketable, therefore we can't use the other two approaches, we must use the cost approach. The cost approach is pretty simple. All you're going to do is sum up the full amount of the construction, building materials, wages, architect fees, contractor services, permits, utility hookups, etc. All of those costs just are placed together into the building's value, and that's the cost approach. So you just need to get a value for each of those. However, if you were to try and actually do the cost approach on some other property and you needed to replicate that property to get that cost value, then what you need to do is look at the cost of producing an exact replica in a replacement of the building you're looking at. So suppose we're looking at a building that is 1,500 square feet, that is built in 1950s, has 3 bedrooms, 2 bathrooms. Then we would look to see how much would it cost for us to build an entirely new home that has 3 bedrooms, 2 bathrooms today, despite the fact that it was built in 1950. This is building a cost under today's method of construction that has equivalent usefulness. I said 3 bedrooms, 2 baths. Equivalent usefulness means building a new building that has 3 bedrooms, 2 baths. The same use occurs, even though it's built with today's standards. You would look at that replacement cost. The replacement cost, or the building construction cost, of the new building with 3 bedrooms, 2 baths is applied to the old building built in the 1950s for its cost appreciation method. Okay? And the way you can do this is pretty simple. You can go through each room in the building and use the square foot method. So not every room in the building has the same cost to construct. A bedroom is far cheaper than a kitchen. So you would get the square footage for the bedrooms, you would get the square footage for the bathrooms, you would get the square footage for the kitchens, dining rooms, living rooms, etc. And you would apply the appropriate square foot cost to each of those rooms. Now, the way you get the square foot cost is to get the cost of the room and divide it by that square footage. And this is pretty standardized across time, and you will find these in cost books. Okay, they're published material that real estate agents and contractors have access to. And these cost books basically say a kitchen is going to be constructed for $67 per square foot. A bedroom is constructed for $30 per square foot. And of course, those numbers are not necessarily the case for your local area. It depends on where you are. In New York, price per square foot can raise as high as $200 to $300. In other parts of the United States, it can be as low as $15 per square foot. It just depends on where you live and the cost of real estate in your area and construction. So you look up these costs per square foot in each of the books per room. You multiply the room's size by the square foot, and that's how you get the price of that room. You add up all of the values of the rooms to get the total cost of the building. So here's an example of what that looks like. We have a dwelling. It is at 1,600 square feet, and it's going to cost $60 per square foot. And we're not going to make any adjustments per room in this type of dwelling because the cost per square foot is applied evenly across all rooms in the building. So there's no reason to split out the kitchen or the bathrooms in this case. However, there's a dishwasher, and this dishwasher is apparently extremely expensive at $700. And there's also a fireplace, which is also extremely expensive at $4,000. And we would add these on to the original dwelling cost to bring us to $100,700 rather. Excuse me there. And this is not including the garage, not including the driveway, doesn't include the patio or the landscaping. As you can see, those are all added on next. There is a 400 square foot garage, and the price of construction for a garage, as it's effectively just a cement floor and a roof, is $30 per square foot. There's a driveway, which is just laid cement. It's 900 square foot, but only costs $2, so it's 1,800. There's a patio, which is probably paved with stone, costs $6 per square foot for 500 square feet, so $3,000. And then landscaping is given at cost of putting in the landscaping by your landscape architect, and here given $2,000. Total is $19,500. Now, there's additional costs that related to the construction, the financing, getting the permits, etc. All of that comes with an additional 10% premium on the value of the cost estimate, which brings us to a grand total of $131,450 for the property. So as you can see, this gives you a pretty good estimate for the cost that it takes to build a property based on a standardized set of rule books. And as you can imagine, this cost estimation method is pretty good in the local area for determining a similar cost value that is comparable between properties for the purpose of setting taxes. So this appraisal method is usually used in tax estimations because it's standardized across properties. If you were to do market value, then you are pretty much playing into the game of, well, this house had 2.5 baths, so we gave a premium to it. But it may not be the case across town that they get 2.5 bath premiums, okay? Whereas in the cost estimate, it's the same regardless because you're using the same standardized book. So you can get the same application of taxes and pretty well equitable and fair distribution of the tax system. Remember how taxes work for property taxes. The governing body sets the budget and then divides that budgetary need among all of the residents in the area. And they apply that as the tax rate for all of the residents. And then if we go through and do appraisals, we need to get those correctly. The appraisals in this case for tax purposes likely to be done on the cost estimate method. After you have obtained the cost estimate, you would then have to depreciate the value of the building. As we said before, the building was built in 1950, and even though we're going to use today's cost of replacing the building, we're going to depreciate that building for 50 years. Obviously, over 50 years, there's going to be physical deterioration that occurs to the building. This is the normal wear and tear from the building existing. You cannot get away from it. So if we had set an estimate of $131,000 in today's cost to replace the 1950s building, we would then depreciate off 50 years worth of property value on the building, which would be pretty significant. And we could see then that the property is not going to be worth $131,000. It may be worth, say, $80,000. And that would be an appropriate value we would give to that building. There's another two types of depreciation we have to be aware of. Functional obsolescence is where the fixtures in the homes become out of date or out of code. It's somewhat humorous to imagine, but there are some homes that have plumbing which cannot accept large amounts of human waste. And so you must use toilet paper that goes into trash bins. This seems strange to us, but in other parts of the world, this is actually extremely common. In the United States, code makes it so that certain diameter of pipes have to be used to allow for modern human waste control. But again, in the rest of the world, that's not the case, and so they are functionally obsolete. In the United States, you also have pipes which may be lead-based. Those are functionally obsolete. They are also out of code, and so you may have to replace those at a significant cost. And the cost can be called curable or incurable depreciation. Curable depreciation is where a cost can be fixed reasonably. It's not too expensive to have it redone. Incurable depreciation is where it is a very expensive thing to fix. For example, if your home was built with asbestos in the walls and in the ceiling, that is typically an incurable depreciation because it is extremely expensive to remove asbestos. It is also extremely expensive to remove lead piping, but it's far more expensive to remove asbestos, and that is an incurable depreciation. It's also out of code, and that is an outdated method for building. Okay? Economic obsolescence is the last one, and that is where some external economic force has made the building's value depreciate significantly. So you may be in an area that no longer has a cost job center. So a factory was originally in the town and then that factory closed, or a university was in the town and it has suffered a loss of students and so professors are no longer employed. Anything that causes an economic depreciation in the local area due to either lack of employment or significant hardship that has occurred would be considered an economic obsolescence on the property. But for the most case, economic obsolescence doesn't exist, and most properties appreciate over time. Okay, so if you're not going to use the cost approach, you have one third and final approach you can use. That is called the income approach. Under the income approach, you are trying to relate future income with the current value of the property. And this is what you should have learned in gross in B Core 340 for almost every asset. Take the present value of future cash flows. Capitalization is doing that discounting for you. It's just all bundled into one single number. So this is very similar to what you would have learned with calculating the value of preferred stock, which is a fixed income security. You're going to take the annual income and divide it by the capitalization rate. That provides you the value. So for example, if a property throws off $18,000 of cash flow, and if you needed a 9% discount, then you would be willing to pay $200,000 for the property, i.e. it is also worth $200,000. So you can see that this calculation is fairly straightforward, except for if the income goes up a little, then you will see a large change in the value of the property. Okay, because you're dividing by 0.09, it could go up $15, $17 just by that $1 change. So it's pretty significant, and you have to be very careful in your assumptions on the income the property is producing. If it's not producing $18,000, you could be off a large amount if you were only saying it produced $17,000 or $19,000 in the other direction. So you have to be very careful in your estimation of what the income is. You also have to be careful in your estimation of the discount rate that is appropriate to apply in the capitalization. If you get the wrong discount rate, you will end up overpaying or significantly underpaying for the property. Underpaying, not a problem. But you could be overpaying for the property as to what you think you should pay for it, and which is not a good idea at all. So how do we do this income method? Well, first you need to be able to get the income, and there are a few ratios you need to be aware of in calculating this income. The whole idea is to get the net operating income for the property, and the way you do that is you get the rents subtracted by the operating expense. First, to get the rents, you need to compute the effective gross income, EGI, which allows for the deduction of vacancy rates. So if a property is going to have full gross rents of $100,000 per year and the vacancy rate is 20%, then you will allow an allocation of $20,000 per year, assuming it will not be paid. That's the vacancy. And then the EGI comes to $80,000. So before gross rents, the full amount is the $100,000. You allow for vacancy at $20,000, 20% of the $100,000. The effective amount of rents you can collect is $80,000 per year. Okay? To get the operating efficiency ratio or operating expense ratio, you're going to take the operating expenses calculated on the property, which is all of the utilities if you pay them as a landlord, property taxes, maintenance costs, management fees, etc. You're going to divide them by your effective gross income, and that gives you your OER. So this is a pretty easy method to using to calculate the efficiency of your rental property. The overall application rate or overall rate of capitalization is the same rate that you would use if we were to calculate a growing perpetuity, such as what you found when calculating Gordon's growth model on stocks. This capitalization rate is the inverse of that 1 plus G divided by R minus G. But there are also other costs that are included in it, such as depreciation, the loan's interest rate, how much you took out on the balance of the loan, and the pay down that you will receive on the mortgage. All of that was calculated into a set of tables by L.W. Elwood, known as the mortgage equity tables. And they produce that overall rate. What you would do is go into these overall equity tables and look up the amount of interest rate you have on your loan, the amount of down payment you made, depreciation that has occurred, and any appreciation you expected might occur on the property over the next few years, and you would look up the appropriate rate to use for your capitalization discount. You would then take the NOI you had previously calculated and divide it by this overall rate, which would provide you the value that you should pay for the property, already assuming depreciation, appreciation, and any interest on your loans built in. So it's a very convenient method that L.W. Elwood created. All right, that is the end of Chapter 18 and the end of the appraisal material we're going to cover in this course for valuation. Next, we will cover REITs, real estate investment trusts, And finally, we'll end the class with a discussion of the 2008 housing market crisis.